This is Macro Analytics, delivering frank conversations on global macroeconomics and market analysis, outside the mainstream, featuring discussions and debates between Gordon T. Long, publisher and editor of GordonTLong.com, and his guests. The content of this discussion is strictly the opinion of the participants. It is in no way a solicitation for business, nor is it to be considered investment advice of any sort. Always consult a registered investment advisor before making any investment decision. These discussions are extremely hard-hitting and terribly frank, and parental discretion is advised. Now, on to the show.
Good morning. I'm Gord Long with Gordon T. Long, and I have with me again this morning Andrew Joseph, who is no stranger to most of our listeners. Andrew's the principal of Golden Phi, publisher of the Triggers Media Publications, Inc., and editor of the Triggers webzine and website. Welcome back, Andrew.
Thank you for having me, Gordon. It's great to be here.
Tuesday, we had a great discussion, and we kind of finished off talking about gold and what we were anticipating as we were seeing then, with especially the dramatic moves Friday, Monday, and we're actually unfolding as we were talking. So we have some charts to share with our listeners here this morning. Andrew, I thought that we just kick it off with some of the charts that we had on Tuesday to position the charts that we want to show here this morning. Prior to this breakdown, we were looking at this particular chart, which was really showing that we have a consolidation, a classic wedge. It led us to believe we were going to look for a DE combination here. Whether we would maintain that support level, but it looked like it would. And then from there, my thesis is that we will see the beginnings of overt monetary financing, which is the next major round of reflation. That is the replacement for quantitative easing, and that is outright monetization of deficits, basically happening in Japan, and we'll begin to see this with the other countries, the other members of the currency cartel, and I'm looking for somewhere in the area of anywhere from $12 to $15 trillion of increase in balance sheets within the next 18 to 24 months, spread out over the Federal Reserve, the ECB, the Bank of Japan, the People's Bank of China, Bank of England, and the Swiss Bank, also included in that cumulative total. And it's tracking quite well, Andrew, to the fact that gold, it's an R-squared fit with the cumulative balance sheets, and it turns out that gold goes up around $210 per $1 trillion of increase in those balance sheets. So this is about trying to take some of the pressure off the gold, because the public and funds have been starting to enter in gold, even though it's been in this major consolidation, and they're really concerned about some kind of a liftoff here, especially with the large bullion banks with major positions, and there being a shortage in the physical. There's a complete disconnect between the physical. When we went to this particular chart we showed on Tuesday, that says we've had a complete breakdown of that consolidation triangle, but it's still part of a consolidation, and we've broken down through this, down through 1300 level in here, and looking like at least at this point when we drew this on Tuesday, a classic ABC, but it doesn't take away from the fact that we'll see this reflation. A point I'd made, and we made on Tuesday, just as the last chart here as a recap, was a relationship going on that's happened since Japan has brought forward this massive reflationary change of trying to drive down the yen. And since the Bank of Japan announced that 2 weeks ago, all of the markets have increased dramatically in the volatility. And one of the things we've seen is this relationship between the interest rates and the volatility in the Japanese bonds relating to gold. And that ties into the fact that value at risk, which increases when, or decreases if you would, when you get volatility, has forced banks to have to liquidate assets to be able to keep their value at risk in line with the regulatory requirements. And so that's forced selling, not necessarily in gold, but forced selling that eventually has led to this volatility and, in fact, the increase in gold. What we've seen, Andrew, and these are the charts that have come out over the last few days, the drop and the sudden spike in gold is a 7 sigma event. And a 7 sigma event is actually just unheard of. That's how dramatic this has been. Put that into perspective, that's like meeting somebody that's 7'7". When was the last time you met somebody that was 7'7", Andrew?
I don't know if I ever have.
Exactly. Some people have. Even at a basketball game, the Celtics are in town. Very seldom is there a guy standing in the court that's 7'7". So rare to say the least. So what would prompt so simply rare? And of course, that's what everybody's grappling with. Well, when you get into the data, what you find out, somebody sold 400 tons of gold in 2 hours. And we're talking a major part of the world's total production of gold in a year of production that was sold. Now, it was actually, they sold 100 tons, and then 2 hours later sold 300 tons. So that's selling 300 tons in less than 30 minutes in a weak market, low volumes. Now, if you're trying to get the best price for your gold, Andrew, is that how you would do it?
No, I don't think so.
You would probably sell it over a protracted period of time, and you sell it into some volumes. Wouldn't you be doing it that way?
For sure, yes.
So you say, well, it must have been a panic. Even margin calls, they don't operate in any kind of fashion like that. Of course, that's also suggesting that maybe somebody wasn't selling gold. Maybe, in fact, it was just a naked short. And naked shorts, you can sell unlimited amounts of naked shorts because you don't have to have the gold or any pledge of even having access to that gold. It's completely naked. Of course, Andrew, I don't know if you do a lot of naked selling, but it's very, very difficult to have the collateral available even for anybody to allow you to sell naked anything, ever mind that amount of gold. The only people that can do that are the gold bullion banks.
Yes, exactly.
Unless you've got somebody who had 400 physical tons. I have up here a chart that shows the COT of who held all of the shorts. And you can see on the right-hand side all the gold and silver and precious metal shorts that were available, and you can see that they were held by the 4 largest bullion banks. So the only people who made a fortune on this, and literally a fortune, were the people who could in fact sell short, could write naked shorts. And that doesn't mean they necessarily even made a fortune. It may mean that they were simply trying to get prices to the point to cover their shortage of physical that they have to deliver. In fact, they don't have the gold that they have to deliver because they've been playing games with it. And we know there's a shortage of physical, and in fact, the paper is completely disconnected from the physical market. I don't know. These look like pretty serious fingerprints if you were doing any kind of forensic work, right, Andrew?
Well, it almost seems obvious, but you can't really know for sure what the games are playing, right?
You don't. You don't know, and there's been enough, the GATA group, others have proved this time and time again. You've had people like McGuire testify on what's going on, but nothing's ever done. Nobody's ever charged, and so we have to assume that we're just reading into things that don't exist, but
Yeah, it wasn't a natural event as we've gone over.
Are you going to believe your eyes, or are you going to believe what you're told?
Exactly.
So we're told to believe what we're told, but not what we see. So I don't know what's happening here. So it does smell. And here's your charts, Andrew. I sorry to take so much time there, but I wanted to give some background of the facts and the data that's coming out that supports this dramatic drop.
For sure, it helps with the understanding.
But when it drops, we don't know what would trigger it. And we always say that, we don't know the triggers, but we know when it's triggered what the high probability trading zone it's going to go to, right?
Yep.
That's what it did. And that's what it's doing here on your chart. Andrew, can you talk to these charts you have?
Sure, for sure. If we look at the one we have up now, point A was back before the beginning of the week, obviously before we had the drop. And we had said then that we were looking for a lift up to the B and to continue on with the wedge pattern that you had shown us earlier. However, I had also said that if that support does not hold, that we will probably fall down to the 1400 range and into where C is, and that's the next Fibonacci spiral, and that's what happened. It broke. We couldn't have known whether it would or would not. Like, I think our bias was for the bounce, but if you were just playing triggers and not what you think might happen, but actually did what it did happen and trade what the market did, you could have got that, and it actually went to where we thought it was going to go if it did break. And from here, we're looking at probably a move right where I have X. There's follow the Fibonacci line, Fibonacci circle up to that point, and then break again and come down to the next one, and I have a D down at the next Fibonacci, and I don't know if it'll come right there or not, but definitely come down to that Fibonacci circle at some point if the current one breaks. Now we have up is the 5 count that we're potentially seeing of what just happened. The major drop that we saw was most likely a 3, and we're putting in a 4 right now. And then we'll have to see how much this 4 extends. It looks like it's almost ready to be completed, but sometimes they can be a little wanky, these alternate counts, and the consolidations aren't necessarily always perfect. So if it does end at the 4 soon, then we're looking for a 5th. And originally I was thinking we could have another really strong down and down to the D that I was showing, the next Fibonacci circle. However, talking with you, Gord, earlier, I think it might not be quite that. The 1-2 is very shallow, and so even extensions of that 1-2 for the 5th wave will only bring us slightly lower than where the 3rd ended. So we'll see if that plays out. And I think you have another chart that shows this.
This is a great chart, on the shorter view, the 60-minute chart. And my experience generally with these kind of charts is that 5th wave will be a Fibonacci extension of that 1 wave up in the left-hand corner. So even if it was 2.618 or 3, it's somewhere as you've got indicated. And we have that gray channel resistance area is very, very strong. And with the panic that we've seen, it would suggest to me that we don't get a double bottom at the 3 level. We break through it so that it's broken that. There's more concern, more panic. It goes down marginally lower and then puts in a bottom and then starts to lift up. And it's the right kind of symmetrical pattern to me historically. And also the bottom, that Williams number to me is very, very telling. Because even if we get this lower, the Williams number will still be on an upwards trend. So we got a divergence, and that divergence is suggesting that we have a bottom, not the bottom, but a bottom, and a bottom that would rally up. So that this whole structure that we're looking at, this 1 through 5 wave, is really the C wave that we have labeled here. And that big blue circle, I don't necessarily know it'll hold at the black channel that we've drawn in, which is parallel, which is normally where it does hold, and would hold somewhere around that concentric. It might be just a little bit lower and deform that. I don't think that's important as much as it should be a bottom. And you can see on the bottom oscillator too, it's suggesting it's somewhere in here. Enough that we start a protracted lift. Not that it's going much higher in price, but more that it burns up time as we move to the right. To me, from a symmetrical ending terminal pattern, which I'm showing here as an A, B, C, D, E, would suggest that we go up and probably hold that ring, that concentric Fibonacci ring that's labeled, shown here in red, and then drop down where you see a lot of concentration of various measurements on your D ring that you were talking about, Andrew.
Exactly.
Somewhere in there. That's what it's suggesting to me. So what you've had is multiple scares. This blue ring is giving us a combination of scares. Then there's this protracted period where people that thought they bought on the dip have made some money. Then it gets slammed again. So you've had 60 days of losing money on gold. The public will be scared out. They're already right now they've rushed in that they think that's a bottom and it's time to buy. And as that peters out and then it gets another down, you'll change the whole sentiment. And that's what this is about. Because as I started with, the central banks are going to print something in the area, in my mind, north of $10 to $15 trillion in the next 18 months. If they do that, gold going to $4,500 an ounce. That's the basic arithmetic of what's going on here. So they don't want it going to 6,500 or 8,500 because it really causes tremendous problem with the interest rates and the negative real rates that they've got to maintain with the currencies. So it's not that they won't see gold going up. They just don't want it going up at ballistic levels. They want it to climb a wall of worry slow. Because remember, a vast majority of the central banks are buying all that gold, Andrew. Not the developed countries. No, at least we know of. They're in fact selling, but all of the country, China is just buying it. They can't buy it fast enough right now. And the latest numbers of gold going through Hong Kong are staggering. They even, we thought it was only 500 tons a year that they're buying. It looks like even more that's going through. So it's hard to say what's going on here, truly, but the charts are giving us some pretty good clues. And I think that in this case, these concentric circles, Fibonacci, as for those who listen to us regularly know, we use a lot of Fibonacci's in different manner, whether we are using ellipses that we showed with the Ides of March, concentric, whether we're using spirals, from a Fibonacci combination, which we showed in that our consolidation concentric diamond wedge pattern on the S&P, whether we're using time extensions or price extensions, which is slightly different, or whether you're using concentric circles. And there's a reason that you use them, because they all are, in fact, integrated. But, they're one element of, using GON, using Elliott wave, using all the other tools that you so effectively use. Sorry, Andrew, you were going to say something?
I was just going to comment on the chart further at that, the blue circle that you have is very similar to where we were, at A and what we're expecting. At A, we were looking for a bounce, as we're looking for the bounce now at the blue circle. And the odds are that this is what's going to happen, is we'll have, as you were saying, and how you have it drawn there, that we'll move to the right. And that was my initial thoughts too on that. However, there is a support band there, and if that support band is broken, then the likelihood is that we will move down to the D ring. I think we're going to move down to the D ring one way or another. It's just the exact path and how we're going to get there from here. But understanding and seeing this chart in front of us, you can set yourself up for the triggers on the lift as we move over to the right on the X, or if it doesn't hold and we break, you can set yourself up for the D on either case. But that's using the triggers and understanding how the market's moving through these rings.
Exactly. We'll be back and we're going to revisit this chart again. You do it throughout the week, every week, twice a week, gold specifically. But we'll come back next month with these charts and see how, in fact, they actually did unfold. I think something else, just to wrap up here, Andrew, is we haven't seen this in all the currencies.
No, they're not reflecting it.
When gold moves like this, you should see tremendous activity in all the various crosses. And you brought a couple of charts because you also do all the crosses to track this, especially out of the yen, which I said this is where it's been triggered. Could you talk to what's happening in those crosses?
Yeah, if we look right now, we can see that the latest Euro JPY cross is just continuing on with the move that it's had. There hasn't been anything special. You'd think with the great big move that we saw in gold that there would be something similar here, and the pattern's just continuing on. I mean, we've had a dramatic lift in here since it broke out of the wedge pattern, but that's been going on for a while. That's nothing new.
Well, that's since Shinzo Abe became the dominant person to win the election, and subsequently did on December the 16th in Japan, and his whole Abenomics and whole redirection. You got to look at the time frame. So this lift that's quite dramatic goes into last fall. Yeah. And that's a lot of pricing in of what he was going to do into the Nikkei. And conversely, the dramatic weakening of the yen. But certainly we haven't really seen it since gold has made this move.
It's just continuing on with what it's been doing. There hasn't been any change one way or another. No dramatic lift or no dramatic fall off or any reaction apparent to what's happened with gold.
A cheaper yen and printing this amount of money, if I can use that word, with the expansion of the balance sheets in Japan, is reigniting the Japanese carry trade. And the carry trade for over 20 years is truly what has financed a lot of the expansion, especially in Europe. And we've shown charts just how well that's actually mirrored. So if the ECB's not going to supply money right now, the Japanese carry trade will. And the reason you want a weakening currency, it guarantees that you're not going to get killed on the currency exchange. And the interest rates are next to nothing. So it's free money, as much as you want, with very little risk right now, as long as that yen keeps weakening. And Abe has been very clear to the rest of the world, he's going to make it weak. So it's all out printing time, or not so much printing as taking advantage of the carry. The other one you had was the Euro-US dollar cross.
Yeah, and again, it's continuing on as it has been. There, you can see the last little tail there, that where we are, and there's no big movement, there's no big spike in any direction. It's just continuing on to follow the patterns and the circles that I have drawn in there, the Fibonacci. There's no difference.
Andrew, what is going on here? And this is why it's so important that the macro is integrated into all these technical charts, and that we use the particular technical charts as a selection to make sense out of things, because without it, you can misinterpret the technicals. But the underlying issue that's going on is you have a currency cartel vis-a-vis an oil cartel, the OPEC cartel. And the currency cartel controls 90% of the world's currencies, and that is the US dollar, the euro, the sterling, and the Japanese yen. You want to buy and trade anything in the world, you're going to use one of those currencies as a transaction. And all of those countries have got serious, serious debt problems. So you debase your currency, you can pay the debt back in useless pieces of dollars. The problem is if you debase your currency, it goes down, something else has got to go up. So the only way out of this, if you're a cartel, is you got to do it together, which they're doing. And if you do it together, there's no place to run. And that's why I use the word cartel. Because when it's planned and controlled, it becomes a cartel. And it's all in their best interest to do this together. Now, if you're not in a cartel and you're China, you're Russia, you're the BRIC countries, you're Brazil, you're taking it right in the ear. They're angry, they're furious about this, but there's not much they can do about it. So you're seeing them looking at alternative reserve currencies, that is gold back, for example, in China. That's why you're seeing all those countries buying gold, because the alternative to a debased currency in this cartel is gold. So gold, in fact, is the enemy. So what you're seeing here, in my mind, is a debasement of gold from the perception of it being an investment, because you're crushing the motivation to buy it. And that's what's effectively happening here. You dump 400 tons on a market, you get a lot of people that are hurt. And then there's not the same enthusiasm. So it's a good way of going out and shooting your competition, isn't it?
Yeah, for sure.
So I guess the currency cartel plays like the mafia. I mean, it really plays hardball. So I may be reading too much into it, but if I was a forensic FBI agent, I'd say these are pretty good evidence to take to court. Andrew, we're past our hard line here. We have to break. Any last comments you want to make?
No, I look forward to revisiting these charts in a month's time and see what happened.
Didn't mean to do so much speculating here today.
It's always good to think out loud.
I guess that's all we're doing here, and I ask our listeners for their patience in doing that, but we're sharing the data in real time and what we're seeing. So until next month, talk to you later.
Take care.
Bye.
This has been Gordon T. Long, editor and publisher of GordonTLong.com. New recordings are posted regularly and can be found at GordonTLong.com. New show notifications are available through RSS feed, iTunes, and other social networking venues at GordonTLong.com.